Hello and welcome to Between the Lines, the podcast that dives deep into stories redefining Asia-Pacific's reinsurance landscape. Recorded here in the newsrooms of InsuranceAsia News in Hong Kong, I'm Mithun Varkey, Editor-in-Chief. And in this episode, we will discuss the aftermath of the tragic fire at Hong Kong's Wang Fuk Coast, the extreme weather events that have affected Australia, Southeast and South Asia in the past few weeks. We'll also be going over some of the big M&A stories that have grabbed the headlines in the past couple of weeks. And as always, we'll bring you some of the exciting stories that our reporters are chasing. Our special guest this week is Hassan Omaish, the CEO for Hong Kong, South Korea and Taiwan for Allianz Trade, the trade credit insurer. Hassan talks to our senior reporter Aidan Gregory about supply chain disruptions, insolvencies, as well as the AI boom that is reshaping businesses around the world.
During COVID, it was a very low claim environment or insolvencies environment because the injection of cash by the governments, right? And I think the problem was those companies were struggling even before the pandemic. They survived in a way thanks to the cash injections. But what you have created zombie companies. Now, what we see now, we expect a rise in 2025. Of course, we have seen the insolvencies have risen and continue in 2026 with a turning point in 2027.
We have a full roster today. With me is Deputy Editor Andrew Mullen, Senior Correspondent Aidan Gregory, reporters Joana, Nguyen and Roshan, Nambiar. Welcome, everyone.
Thanks a lot, Mithun. Happy to be back.
Thanks, Mithun. Good to be back as always.
Before we start, I'd like to extend our deepest condolences to the victims and families affected by the recent devastating fire at Wang Fuk Coast in Tai Po, Hong Kong. It's been a big event for us here in the past few days, and we've been actively following the events and developments in the aftermath of the fire. Andrew, can you give us a recap and tell us where we are now?
Yes, it's certainly a big event for us. It's certainly a big event for around the world. This story's caught the attention of everyone. Where we are now, that event that took place on November 26th, 7 of the 8 towers in that complex were destroyed, and the death tolls just crept up to 160 people, with 6 people still missing. From an insurance side, China Taiping, not long after the event, had already confirmed that it was the underwriter responsible for all relevant insurance policies, and this includes $257 million for property and fire-related damage, and there's also contractors' all risk and third-party liability and public liability policy as well. Now, as of Monday, 10,000 active life insurance policies from 25 insurers and 1,800 property policies from 35 insurers have been identified as having been issued. Now, just to clarify, that's not 70 insurers total. That's 35 on the life side and 35 on the property side. Now, those could be same or different insurers, but the authority haven't confirmed that to us. But that's where we are now from an insurance perspective. Those figures have increased. Last week, it was reported about 30 insurers had issued 7,600 life policies and 1,100 general insurance policies. The authorities have confirmed 80% of the property policies are home insurance, personal accident insurance, and domestic helper insurance.
Thanks, Andrew. Joana, on the day when the fire occurred, you went to Tai Po to report for us. How was it on the ground?
Yeah, it was tragic. The moment I stepped out of the train, I could smell the smoke because, the train platform of the Tai Po MTR station is outdoors. And I could see the blaze from afar. And when I reached Wang Fuk Court, I could see the helplessness as well as shock and disbelief of the residents seeing their homes in the inferno. I could also see the community support there as well, with many volunteers distributing supplies while firefighters and rescuers were trying their best as well. But it was a horrible incident and I think traumatic as well for many Hong Kongers.
Since then, you were recently at the Asian Insurance Forum where you interviewed Clement Chung, CEO of Insurance Authority. Can you tell us what he said?
So this interview was on the sidelines of the Asian Insurance Forum. I asked him about his expectation of the impact of this loss on the insurance industry, and he said that it will be borne collectively by both direct insurers and their reinsurers. And he believed that this one particular incident in one particular city is not going to create a material impact on the premium levels. But however, the underwriting conditions may need to be more stringent from now on. And I also asked him about the impact on China Taiping Hong Kong and whether they would need additional external support. And he said that the insurer has good reinsurers backing and their capital is at satisfactory level. So it should be good on its own and will be able to withstand this kind of risk.
That's quite interesting. I mean, also had some really insightful conversations with my industry sources here. One, of course, is that this is certainly a wake-up call for the industry and for Hong Kong as a whole. We've had quite a few fire incidents in the recent past, most notably, of course, the Chinatown fire in October, which we covered as well. So from an insurance perspective, we had first reported that Marsh was the broker to ISS, who was the property manager for the Wangfu Court estate. However, we later found out that the incorporated owners of the housing estate had opted not to join the ISS Hong Kong program, and they went directly to the insurer and placed their risk. For the renovation project, which is the Prestige, the company which did the renovations, they, I believe, has relied on an international broker to place the risk, but not Marsh. One thing that really is quite interesting is that one of the brokers was pointing out to me that the rate online for this particular property coverage was 0.006%. That's 120,000 Hong Kong dollars for $2 billion worth of coverage, which seems wholly inadequate. Certainly some of the people that I've been speaking to in the market have been raising this. They're saying that the rates are not commensurate for the risks that they are taking, which has meant that a lot of the underwriters and brokers who are currently having renewal discussions, be it primary insurance policies or at reinsurance discussions, they're re-looking at some of the policies they have and some of the rates. So even if the prices don't go up, it'll certainly hold further softening, is what the market is saying, which I think is probably good for the market. The other interesting point that came up in some of the conversations is the point about underinsurance. So some of these policies, if you look at the policy in the Wangfu Court, it's only covered for $2 billion, whereas the property value of that whole estate is many times that. So one of the points that was raised was the average clause, which is an insurance provision that reduces a claim payout if the property is insured for less than its full value. So if once the average clause kicks in this case of the policy, the insurance payout could be a lot less than the 2 billion limit that they've bought coverage for. So that could impact the insurance payout. And in the end, the homeowners might be left with very little payment from insurance. And that could be a concern for homeowners. One thing is for sure that this will be a transformative case for the Hong Kong market. We will see some changes, certainly in terms and conditions and in terms of regulations around construction, in the way the Grenfell Tower fire was in the UK.
Indeed, just like the Grenfell Tower fire in London in 2017, it looks like the consequences of this fire in Hong Kong are going to play out for many, many years ahead. Grenfell in the UK led to a public inquiry and an overhaul of fire safety regulations for tower blocks. And it also sparked a cladding scandal, which rumbles on to the day in the UK. With thousands of tower blocks across the country still struggling with unsafe cladding, which needs to be removed. And there have been all kinds of issues in terms of ensuring buildings, which have these cladding problems. So here in Hong Kong, the consequences of this fire are going to play out now for a very long time. And here at InsuranceAsia News, we'll obviously be following the investigation.
Indeed, Aidan, I think we'll be actively following developments and the inquiry that John Lee has announced. Moving on, in other big events around the region, we've been reporting on the hailstorms in Australia, which has also seen some wildfires. Andrew, could you tell us what's the latest on these events?
Thanks, Mithun. Yeah, so the bushfires are grabbing the headlines right now, but before that we had a hail event in Queensland and New South Wales. This was declared an insurance catastrophe on November 25th after thousands of homes were left without power and residents suffered property damage. The coverage for this event was then extended to cover events from November 20th to the 27th, and they are also extended the postcodes covered, which meant any postcode was covered in those two states. As of Friday, the Insurance Council of Australia confirmed that the severe hail and intense storms last month had generated 58,874 claims across both states. Now, that was obviously Friday, so we expect that to have tipped over 60,000 by now. And that had already exceeded the count from the Halloween hailstorms that impacted the region in October 2020. Halloween hailstorms led to 45,000 claims with an incurred value of close to $700 million US. This is according to the Insurance Council of Australia. So we're expecting large claims from this, with these probably bigger than golf ball. These hails are damaging cars, properties, solar panels. And these claims could be quite large. Closer to where we are now, the bushfires. This is just the start of the summer season in Australia, and New South Wales Premier Chris Minns has already said it's quite a foreboding beginning to the season after 20 homes were destroyed in fires over the weekend. Prime Minister Anthony Albanese has already chipped in as well and saying it's a difficult start to the summer. Unfortunately, one firefighter died on Sunday after being struck by a tree while working on a bushfire in the state's mid-northeast coast. Contrasting weather in Australia with hailstorms and bushfires, and we'll definitely keep monitoring those. And the bushfires, we don't expect large claims, but I think the hailstorms are going to be significant claims, and there's already been significant losses there. So the insurers are going to be scrambling around for those, so we'll keep monitoring that.
Thanks, Andrew. Yeah, it will be a big loss event for insurers, and I think Suncorp has already said that they've blown through their retention on their reinsurance program. I believe my sources tell me that would be very similar for IAG and RACQ. So we'll have to wait for the numbers, but it's going to be likely be a very big loss event for Australian insurers who otherwise had a fairly benign year. So we'll see what happens. When closer home for us in Southeast Asia and South Asia, it was been a few weeks of relentless rains, and we've had some rare windstorm events in the Strait of Malacca as well as in the Bay of Bengal. Joana, you've tracked some of the developments around it. Can you tell us what's happening?
In late November, many Southeast Asian countries experienced severe NatCat damages. In particular, Tropical Storm Senia, which followed a rare trek through the Strait of Malacca, has led to widespread flooding in Thailand and Indonesia, with combined economic losses estimated at about $20 billion US. Thailand in particular estimated that this event will be one of the costliest cat events in the nation's history, with current estimates of around 15.6 billion USD in combined direct and indirect losses. Meanwhile, the Philippines and Vietnam were also impacted by Typhoon Koto over the past week. While its impact is relatively benign compared to other typhoons this year, these two nations have been reeling from the impacts of other typhoons earlier. So this Typhoon Koto will still worsen the damages that they have so far.
That's true. It's one of the worst economic loss events for Thailand. Also in Sri Lanka, where Tropical Cyclone Ditwa caused extensive damage. Apparently it will affect the country's GDP, close to 1% decline in GDP because of the effects of the natural catastrophe. So this will continue to be an issue for the region. And one of the things that stood out from Moody's report from earlier this week was that we're already seeing La Nina conditions in Southeast Asia and South Asia, and that could mean wetter monsoons and more flood events in the region. So that's something that we'll need to keep an eye on. And in fact, the data, actually, Joana, you did a story based on the Munich Re report for the year on tropical cyclones, and nearly half of the claims came from Asia Pacific. Can you tell us more?
Right. So according to that report, total losses from tropical cyclones this year globally were about $22 billion US, and Asia Pacific accounted for around half of them. And out of that 22 billion losses, only 4 billion were insured. So Asia Pacific in particular saw about 27 tropical cyclones this year, 16 of which were of typhoon strength, while 5 became super typhoons in categories 3 to 5. What was striking about the typhoon season this year was that many storms traveled relatively far south. And as a result, the Philippines, China, and Vietnam, as well as neighboring countries, were frequently affected. In contrast, Japan, which is highly prone to natural disasters, was largely spared from tropical storms. So There are a lot of other insights from that report, so we do encourage you to take a look at the article, to have a read the article to see more from that.
Thanks, Joana. That's right. I mean, Japan may have been spared the typhoons, but we saw a 7.5 magnitude earthquake hit Japan earlier this week, and the Japanese Meteorological Agency has issued a mega quake warning, saying that a magnitude 8 level earthquake, the risk of a magnitude 8 level earthquake and possible tsunami has increased. So that is something that we'll have to keep an eye out for. So on from all the catastrophes to more cheerier news. It's been a big week for high-profile M&As in the region. We've seen some big private equity interest in the Australian brokers, while also updates on Japanese and Korean insurers' American ambitions. Let's start with the Mitsui's WR Berkeley deal, which is quite an interesting one. Aidan, can you give us the details?
Sure. So the theme of inbound Japanese interest in the US insurance market, is continuing at pace. This week we've seen Mitsui complete its acquisition of a minority stake in Berkeley. It has a 12.5% stake now, and which is enough for the Japanese insurer to obtain a board seat. The Berkeley family, who are the biggest shareholders in Berkeley, didn't sell any shares in the transaction, and they remain the largest shareholders, and that looks set to remain the case for the foreseeable future. This deal is quite interesting because it goes against the grain of what we've been hearing from deal makers, which is that the Japanese insurers who are sitting on a mountain of cash after being forced to unwind their cross holdings by regulators, all the deal makers have been saying that the Japanese are out for big ticket, full control acquisition targets, and what Mitsui's been doing goes slightly against the grain in terms of, they're happy to have this minority stake and to sit there and see how it goes. It's worth also mentioning that Mitsui's also acquired a minority stake in recent weeks in Bearings, the US asset manager. And again, this is a minority position, like they're not going to have full control, but they seem happy to build these stakes in these, quality storied US companies that, they're obviously very attracted to.
That's true. I think Mitsui is certainly playing the waiting game with the WR Berkeley deal, which is, as you said, quite unusual. I mean, it's not quite unusual for the Japanese, but at this point in time when they have so much money, we would have expected them to move faster. But we'll see how that plays out. On the other hand, DB Insurance, the Korean insurer, has got shareholder approval from the shareholders of Tiptree to acquire Fortegra, which is a US specialty insurer. This is quite an interesting situation because there was a few activist Tiptree shareholders who were campaigning against this deal, and they were concerned about the usage of proceeds from the sale of Fortegra to DB. And it did seem that there could be some opposition to the deal. But in the end, the shareholder voting happened first week of December, and I think they've secured a majority of the votes, and that deal is going through. So that's some successful deal making for DB, and will be quite interesting for them, for their American ambitions. Well, we've also seen a few deals in Australia, and that's been not that successful. Aidan, we saw the AUB bid fall through. Can you tell what happened there?
Sure. So the private equity love affair with insurance brokers has been a huge theme in recent years, and we've seen this massive wave of private equity takeovers of brokers happening, not just in Asia Pacific, but around the world, in the US, in Europe. I think private equity, are attracted to insurance intermediaries because it's capital light. Insurance brokers, don't have the strict solvency regulations and obligations that insurance carriers have, and they earn a nice fee income stream that's very attractive, basically for outside investors to come in and gain access to. So there's been two quite high profile situations in Australia in recent weeks that it hasn't yet led to any deals being agreed. We saw the negotiations between AUB and a consortium comprised of EQT and CVC, two leading global private equity firms, but it seems to have fallen apart after the two parties couldn't agree on price. So, I mean, AUB came out with a statement at the start of last week saying that, it remains committed to its existing strategy and that, the takeover's off, basically. We've also seen reported interest from Blackstone in acquiring Steadfast. The Australian reported last week that Blackstone was weighing a bid for Australia's largest listed insurance group, which will be this will be a pretty sizable transaction for the Australian insurance industry if it goes ahead. And Blackstone has a long history of making quite big investments in the insurance sector, particularly in the last few years. They've they bet big on the Lloyd's market in the UK, and they own a lot of insurance assets around the world. So it wouldn't be surprising that they're looking at getting involved with Steadfast.
Yeah, we saw Blackstone acquire a broker in India, Ace Insurance Broker, that we'd reported in October. So it's no surprise that Blackstone's interested in insurance intermediaries in the region. Another big news, one of the big people move stories that we have had recently, Allianz Trade, the reinsurance arm of the big German insurance group Allianz, saw a change at the helm of affairs in Asia. Kenrick Law, who's been leading the reinsurer for a long time, has stepped aside. Roshan, can you unpack for us what's happening with the leadership change at Allianz Re?
Yes, so Allianz Reinsurance, they appointed Anna Coles as the regional CEO for property and casualty client management in Asia Pacific. The role will be effective from January 1st, and like you said, she will take over from Kenrick Law, who is departing the company after 12 years. Coles is currently in Munich, but she will relocate to Singapore to lead the third-party P&C business across the region. And she actually has spent 17 years with the reinsurer and previously worked in Singapore for 3 years from 2015 as a P&C client manager for Asia Pacific.
Thanks, Roshan. That's an interesting change at Allianz Re. In other big stories last week, we saw that Guy Carpenter won a big lawsuit against LK Re, the Korean reinsurance broking group, in the Singapore High Court. Andrew, you spotted that. Can you tell us what happened?
Yeah, thanks, Mithun. This has been a very popular story on our site, and if you've not read it or not heard about it, you'll understand why when you hear the details. So, as you mentioned, Guy Carpenter won a lawsuit in Singapore's High Court against two former employees who had lured a big client away to the South Korean insurance broker LK Insurance Services and its subsidiary LK Re. Guy Carpenter estimated the loss of business from the client, which was Samsung Fire Marine Insurance, cost it at least $1.3 million in brokerage revenue. This was according to the media reports. The two former employees had joined LK Re in 2021, having resigned from Guy Carpenter earlier in that year. In the lawsuit, Guy Carpenter argued that all four defendants had worked together to establish a facility to take the business. This was domestic warehouse risks business, and persuade them to place the risk with the new company. The defendants denied the claims, countering that the decision was just a commercial decision, and they had not influenced it. But all four defendants were found liable for taking part in the conspiracy using unlawful means against Guy Carpenter and diverting the business to LK Re. The level of damages to be paid by the defendants to Guy Carpenter is going to be announced later, and that's going to obviously with legal costs to be considered as well. So quite an intriguing story that came out, and very popular story on the site for our readers, that one.
Thanks, Andrew. Yes, we'll try and keep on top of this, and I'm sure everyone's interested to find out how big the payout will be that the court orders. So let's talk about future stories. What are we working on here? Joana, what's keeping you busy?
One of the stories that I'm doing right now is a spotlight story on Asia Reinsurance Brokers, ARB. So this year is their 25 years anniversary, and I'll be speaking to William Pang, the group CEO of ARB, later this week, and he'll be sharing with me about the development journey of ARB the last 25 years, any specific opportunities and challenges that he sees in Southeast Asia, especially in markets where ARB has presence, as well as his observations or expectations about the upcoming 1/1 renewals.
Thanks, Joana. Aidan, what are you following up on?
So as the end of the year approaches, I've been speaking to deal makers about the prospects for insurance industry M&A in Asia heading into next year. It's been really interesting so far, and we've spoken to quite a few really good experts in banking and the legal side. Obviously, as we touched on in this podcast, outbound Japanese M&A, remains probably the biggest theme. One of the biggest questions, will be whether we will continue to see most of that capital flow in the direction of the US, or, whether some of it will get redirected in the direction of other, faster growing markets like Southeast Asia, and or dare I say India too. So that's the big theme. The problem in Southeast Asia and India for international insurers, looking to increase their exposure to these markets, is that it's quite difficult to actually go and buy a target in these places, owing to ownership rules, the lack of new licenses, all kinds of things. So it's quite a complicated picture, but it certainly makes for an interesting story as we're heading into next year.
Certainly, there's quite a lot of conversations around M&A happening, so we'll certainly worth watching out for that story. Roshan, I know you're busy chasing up the 1/1 renewals. What other stories are you working on right now?
So yeah, I've been chasing the 1/1 renewals. So we've been planning to write a story on that. And I've been speaking to brokers and getting their read on pricing, capacity, market sentiment, etc. Currently, it's still in the works, so expect insights on where negotiations are tightening and where clients may see some relief. On top of that, I'm also working on a piece about data center insurance. So data center insurance is becoming a major focus in Asia Pacific as operators face rising risk from power instability, NatCat events, and technology failures. I've been reaching out to insurers and brokers across the region to understand how underwriting is shifting, what capacity looks like, and how cyber and property markets are influencing their coverage. We are seeing a lot of movement, and the feedback so far suggests that this will be a key area to watch going into the future.
Absolutely. I bet that'll be very interesting. Roshan, data centers are the hottest topic in town. On my end, I had a really interesting conversation with Rob Shemek, who's the CEO and co-founder of Boltec, one of the few successful insurtechs, possibly, certainly in APAC, possibly in the world. A really interesting conversation, and I'll have a story on their plans very soon. And I'm also chasing a few exclusives and few stories from around the region. I'm hoping to get them out soon. I mean, there's certainly one about a new MGA being launched by former Catlin regional leader Bobby Hira Singh. I'm hoping to get that story out soon. There's also rumors about developments at Everest Insurance in the region. I'm trying to get that story out in the next few days as well. So there'll be quite a few interesting exclusive stories on InsuranceAsia News in the coming days. It's been a fantastic meeting, guys. Thank you very much, and let's get back to work.
We're joined on Between the Lines this week by Hassan Omaish, CEO of Allianz Trade for Hong Kong, South Korea and Taiwan. Welcome to the show, Hassan.
Hi, Aidan. Thanks for having me.
Hassan has been with Allianz Trade, which is formerly known as Euler Hermes, for more than 15 years and has worked in the Middle East, Singapore, Hong Kong and France for the trade credit insurer. In October, Hassan returned to Hong Kong from France to take up his new role as CEO for Hong Kong, South Korea and Taiwan. How's it going to be back in this wonderful city, Hassan?
It's great to be back. I lived here in Hong Kong for 2 years. Then I moved to Paris for 2 years. So it's really exciting to be back here in Hong Kong.
Great. Your roles around the world have given you a front row seat in terms of the volatility and disruption that we've seen in global trade flows. How are the current trade tensions between the US and its trading partners in Asia Pacific driving demand for trade credit insurance in the region, and how are your clients reacting to all of this volatility that we've seen over the course of the last 12 months?
I mean, if we look at the macro and structural supply chain shifts, global supply chains have moved from a decade of, I would say, intense focus on maximizing efficiency and minimizing costs to sort of hyper optimization, and often at the expense of flexibility and resilience. Now, the focus is on diversifying supply chains, increasing regional production, reducing dependency on single source to really mitigate the risks associated with the geopolitical tension and uncertainty. And if you think about it, it's not just companies competing with each other It's their supply chains that are in competition. So there are a number of trends when we look at global trade and supply chain dynamics. And I think number one is, the geoeconomic fragmentation, which is the division of global economic systems, which is a persistent feature. You look at the US-China tensions, trade and industrial policies, national security mandates are really reshaping trade flows. We estimate, for example, that a plus 10% rise in geopolitical distance index reduces bilateral trade by minus 2%, highlighting the importance of political alignment and adaptive supply chains. Also, what's important to mention is the sectoral concentration risks, which remain really high, especially in semicon, batteries, EV components, pharmaceuticals, etc. It's a good example in China. It's a global leader in clean energy industrial products, accounting for 60% of global manufacturing capacity in solar, wind, battery technologies. And recently we have published a great report on that. It's about the electro-state era from made in China to power design and financed by China. China as the world's first electro-state and a critical provider blueprint for the world on clean tech. Now, if talking about China, I think I can mention a third dimension or aspect looking at the global supply chain shifts, which is shift to China plus one, nearshoring, friendshoring. Firms diversify, of course, selectively offered for critical components rather than for production. And another one I'm personally experiencing at the moment, I was based in Paris, as we mentioned, 2 months ago, and my shipment, my furniture, got delayed for over 2 weeks, which has disrupted my holiday schedule and finances. So logistics volatility, I think it's an important aspect. Freight disruptions, Red Sea rerouting, port congestions, etc., has really re-exposed, I would say, the fragility of long, lean supply chains. And global logistics have become more vulnerable to shocks since the pandemic.
Yeah, it's certainly a very complicated and, and difficult and geopolitical backdrop for companies to be navigating at the moment. So how are companies adjusting to all these disruptions? And, is there a big growth opportunity at the moment for trade credit insurance within that backdrop?
Clearly, the future is likely a hybrid between just-in-time for efficiency and just-in-case for resilience. So companies are recalibrating, I would say, not abandoning just-in-time, right? So firms are adding redundancies, such as multi-sourcing for strategic components. Inventory levels remain structurally higher than pre-pandemic norms, which reflects new risk appetite. So in early 2025, as you recall, was also marked by front-loading and stocking in preparation for the trade war. However, the cost of capital and inventory financing limits how far firms can swing towards just in case, which adds more pressure on financial resilience and working capital. So volatile supply chains naturally translate into pressure in corporate liquidity, especially for SMEs. Longer lead times and logistics disruptions tend to increase the days inventory outstanding and days sales outstanding. So we're talking about locking up cash. Higher interest rates make working capital financing more costly. We estimate, for example, that higher interest rates make working capital financing more costly. We estimate that a plus 1 percentage point rate shock at 14 billion euros in Europe and $26 billion to working capital financing needs, which is basically to cover its day-to-day operational expenses. Many firms are experiencing a liquidity squeeze now, just as input prices and transportation volatility raise operation cost.
So on the subject of, rising costs and complexity, Allianz Trade actually tracks global insolvencies in great detail. And your last report in October predicted that bankruptcies are going to continue to rise heading into 2026, with Asia being the biggest source of defaults. And, we've also recently seen some very, very high profile bankruptcies in the US, like First Brands and others linked to, opaque forms of financing. How concerned, should insurers be about this rising level of defaults, especially given, the recent high profile cases that we've witnessed?
During COVID, it was a very low claim environment or insolvencies environment because the injection of cash by the governments, right? And I think the problem was those companies were struggling even before the pandemic. They survived in a way thanks to the cash injections. But what you have created zombie companies. Now, what we see now, we expect a rise in 2025. Of course, we have seen the insolvencies have risen and continue in 2026 with a turning point in 2027. So we at Allianz Trade forecast global business insolvencies to increase by 6% this year, 5% next year, before declining in the following year, which is 2027. So tariffs might delay impact until 2026, raising, say, domino effect risks. Then you have the tech-driven business creation, and a potential AI boom could heighten insolvency risk, especially in the US and in Europe. Now in Asia, it's set to be the largest contributor to insolvency increases, accounting for half of the global rise in 2025, even 2026. Asia will see, we predict 3 more years of insolvency growth, with significant increase in Hong Kong, Singapore, multi-year highs in South Korea, in New Zealand, Australia, and Japan, which are export-dependent economies.
But these are massive risks for companies that are trading, and if you're one of your suppliers goes under and stops being able to deliver goods or stops being able to pay you for your services, then it's very, very catastrophic for these companies, especially small and medium enterprises.
Absolutely, and this is why trade credit insurance is becoming a key enabler, Aidan, of resilient, I would say, supply chains. Not only a risk transfer mechanism, but also a data and early warning system. Trade credit insurance provide biorisk assessment and, I would say, continuous monitoring. So valuable when onboarding new supplier or customers, as we mentioned, in a diversification strategies. Companies, as they move towards just in case, so they hold more inventory and expanding supplier networks. So credit exposures, of course, increase, making trade credit insurance part of the what we call resilience credit management toolkit. And talking about working capital requirement, the liquidity squeeze, TCI or trade credit insurance can unlock financing simply as insured receivables, improve balance sheet, and facilitate better terms from financing institutions. And here I think we need to talk about SMEs because, of course, large companies, they pass on the risk downstream. So longer terms of payment are imposed on smaller companies or SMEs. Of course, large corporates, they have the bargaining power. They look at the efficiency, they pass on the risk. And the SMEs, in most scenarios, they will accept the bribe. So that adds a lot of pressure on SMEs. And this is why we are investing heavily to see where we can support SMEs. I always say SMEs are really underserved, overpriced. So we have created a new products, which we call off-the-shelf plug and play, that is affordable, easy to activate, easy to manage. And when I talk about servicing and management, which is how we can digitize it, E2E, as much as possible, and at the same time make it flexible for SMEs. So this is really our focus, is how we can create solutions across the spectrum from SMEs to mid-corp, large corps, and of course, MNCs. And there's a big part of our clientele base, which are banks, especially when it comes to factoring, project financing. So we're trying to create, the full spectrum of products, from short-term credit insurance to mid-term leasing to project financing, long-term. We also created solutions for e-commerce players. I mentioned about SMEs, surety, commercial bonds. So we're really trying to invest in a strategy that is a multi-liner model that can serve, the entire trade community and, of course, the banking clients.
You spoke at length at InsurTech Insights last week about, helping SMEs. And are you finding that, trade credit assurance is really beginning to gain traction among these types of clients?
Yes. So I just concluded, a couple of trips in Asia, mainly in Korea and Taiwan, and everyone's talking about the AI, right? The AI boom. So the current excitement around AI in financial markets, I think it shows typical signs of an asset bubble. I mean, unproven valuations and returns, disconnected and detached from earnings. I mean, although economics can't predict when a bubble will burst, but if we look at the Minsky clock theory, we believe that it indicates we are in a late cycle phase, and there are 3 phases. So our AI bubble risk monitor we assess over 30 indicators related to market signals, earning expectations, financials, fundamental risk. So exuberant expectations are the most overheated, I would say, with ongoing earnings upgrade and high forecasts. Now, in the long run, AI adoption should, in theory, surpass market corrections, but the real danger we are looking at is the market might have priced in decades for growth too quickly, leaving valuations vulnerable if adoption is slower than anticipated. So we published recently a very insightful report, and we call it, is it the AI bubble o'clock? So this is an area where we are monitoring very closely. At the same time, of course, there are a lot of opportunities. We have large clientele base where they need non-traditional solutions. So we're trying to watch it, monitor it, provide market intel to our clients, and at the same time provide them with the edge they need to develop securely.
So there is growing concern in capital markets about the potential for an AI bubble. But AI, the technology clearly has huge potential for the insurance industry in terms of underwriting and processing claims and making those processes more efficient. How is Allianz Trade using AI to underwrite trade credit risks?
Sure. I think the way we look at AI, and we are really investing in that space simply because, we want to boost efficiency and service quality through data and Gen AI. So when it comes to customer service, it's all about speed, accuracy, consistency, and we truly believe AI can support that. So a couple of examples, E2E auto underwriting model. So end-to-end process, 75% automation. We talked about trade credit insurance. It's information-driven business. So when it comes to information, 97% of our exposure cover is auto-create. And when I talk about exposure, we hold around 1.4 trillion euros of covered commercial transactions. This decision explanation, because it's all about sharing market intel, early alert system. So how we can digitize that, how we can look at auto grading model. So that's also embedded. Claims automation. So we have 90% online placement, 50% automation target. And now we also built fraud detection machines, which is very important for us and for our clients. It's based around machine learning. So I would say it's pretty much transformational process, which has started many months ago, a couple of years ago, and we continue to invest in that. Really, it's all about boosting efficiency and service quality.
It's going to be fascinating over the coming years, seeing how the insurance industry can harness this new technology, and it'll be a game changer for those insurers that can use it efficiently. Have you noticed any changes in terms of, the shifting balance of global trade and manufacturing hubs recently?
I mean, all the global shifts, the new trade and manufacturing hubs are reshaping the map. If we look at our 2025 ranking of next generation trade hubs, it shows the economy is repositioning into multi-model. Tariff, sanctions, supply chain changes alter the global flows. To give you an idea, the UAE ranked number 1, Malaysia number 3, lead as multi-model powerhouses with ports like Jebel Ali in the UAE, Port Klang, connecting Asia, Middle East, and Europe. Vietnam again jumps to number 2, driven by exponential export growth. And of course, a new tariff deal with the US that helped massively. Saudi Arabia, number 4, rises sharply, up 11 places, if I can recall correctly, due to lower tariffs and increasing non-oil exports, which is in line with their vision. And by the way, that's why we are trying to create new facilities and uplift our exposures in the Middle East to support exporters, especially now in Asia or indeed in Hong Kong. In August, the governments of Hong Kong and Saudi Arabia, they signed MOU. So we have created new capacities. We have solutions to support exporters going to the Middle East, mainly Saudi. So these hubs together create a broader, I would say, more regional and clearly multipolar trading system.
Yeah, the Hong Kong government has been very clear in terms of its ambitions to deepen ties, with the Gulf, particularly when it comes to trade and investment, and it's certainly a big opportunity for the territory in the coming years.
Absolutely.
Thanks, Hassan. That was really interesting to listen to your views and hear your outlook for 2026. I'm sure next year promises to be no less volatile than 2025, and it seems like volatility is here to stay, and it's very much the new normal for all of us.
Absolutely. I think the watchword is uncertainty. There are a lot of opportunities are emerging. Want to make sure we provide the right solutions. Thank you, Aidan, for your time. Really enjoyed our discussion.
That's all from us in this episode of Between the Lines. This is the last episode from us this year. We'll be back again in the new year. Here is wishing all our listeners a Merry Christmas and a Happy New Year. In the meantime, you can connect with us on LinkedIn. Make sure you're subscribed to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.